The Vanguard Real Estate ETF, ticker symbol VNQ, is the biggest REIT ETF in the world, managing about $65 billion worth of investments and holding stakes in most major REITs. Therefore, a lot of new REIT investors will simply invest in VNQ and be done with it. And this is a great approach if you want to be passive and don't care learning about REITs. However, as I've discussed in some of my previous videos, VNQ and other REIT ETFs have many issues. One of their biggest problems, which cost them a lot of performance, is that they invest in all property sectors, including even those that are facing significant headwinds. Offices are today struggling because of the growing trends of remote and hybrid work, which have already resulted in all-time high vacancy rates. Hotels are also facing growing competition from Airbnb, even as Zoom has permanently reduced the demand from business travelers. Malls are also facing growing competition from e-commerce, which I expect to only accelerate as a result of the AI revolution, which will make online marketing a lot more powerful and shipping a lot cheaper. And these are just a few examples, but mortgage REITs have very poor track records, billboard REITs are very cyclical, farmland REITs have bad track records, diversified REITs that invest across many property sectors have also done poorly over time. My point is that there are a lot of sub-sectors of the REIT market that have very bad track records, and investors could do quite a bit better by avoiding those. In today's video, I'm going to highlight 3 REITs investing in specialty property sectors that have historically been a lot more rewarding than the average of the REIT sector. These REITs will show you how easy it is potentially to outperform the Vanguard Real Estate ETF by simply screening out those struggling property sectors and focusing on the most rewarding ones. Hey, this is Jussi. I run a small investment firm that specializes in REIT investing, and before going into today's video, I want to let you know that I just recently interviewed the CEO of Whitestone REIT for High Yield Landlord, which is my REIT newsletter. Normally there's a paywall on this type of content, but I've temporarily removed it. So if you want to learn more about Whitestone REIT and why I think it's one of the best opportunities in the REIT market today, make sure to click the first link in the description of this video. This will give you access to the full interview for free. The only thing that I ask you is that you sign up for the free newsletter. This will give you access to one free article on one of my favorite REIT opportunities every week. Now let's get started. The first REIT I want to discuss is called VICI Properties, ticker symbol VICI. For a long time, this was our largest holding at High Yield Landlord, and we invested so heavily in it because we thought that its unique focus on casino net lease properties had the potential to significantly outperform the market, including ETFs like Vanguard Real Estate ETF. And now looking back, we're glad that we did, because VICI has earned about 3 times higher returns than VNQ since going public. It was so much more rewarding because it had a unique strategy targeting casino net lease properties, which until recently were ignored by most investors. While Realty Income, Agri-Realty and other net lease REITs were targeting traditional net lease properties such as Walgreens pharmacies, VICI was structuring off-market sale and leaseback transactions with major casino operators, acquiring properties such as the Venetian on the Las Vegas Strip and Caesars Palace. The relative lack of competition for these properties allowed it to secure higher cap rates, better lease terms, higher rent escalations, which then resulted in much higher total returns. In addition to that, it was able to raise new capital and buy additional properties at large spreads over its cost of capital, accelerating its growth even further. But now the REIT is a lot bigger in size, new competitors have also emerged, and the size of its spreads have declined. Therefore, I wouldn't expect it to keep earning 3 times higher returns than the broader REIT market going forward. However, I would still expect it to keep outperforming going forward, given that now it owns the biggest and best diversified portfolio of casinos in its existence. These are trophy assets in prime locations that enjoy very attractive long-term growth prospects, and they enjoy some of the best lease terms in the whole REIT sector, with strong rent escalation, long lease terms, no landlord responsibilities. Tenants are even forced to reinvest in the properties every year, creating value for VICI. And so I think that this forms a strong base for continued outperformance going forward, given that it's set to earn highly consistent cash flow with very predictable growth. Therefore, I think that this forms a good base for continued outperformance going forward. Its existing portfolio and their leases are clearly above average, and that on its own should result in attractive organic growth, which coupled with even a few acquisitions each year should result in enough growth to outperform the market, especially since the REIT is today priced at a historically low valuation, trading at just about 12 times FFO and offering a near 6% dividend yield. The only reason why we don't currently own it at High Yield Landlord is because we slightly prefer another casino real estate opportunity at the moment. However, we maintain it high on our watch list and like its risk reward. The second REIT I want to discuss is Sun Communities, ticker symbol SUI, and just like VICI, it has a long history of significant outperformance relative to the Vanguard Real Estate ETF. And once again, this is because it focuses on a specialty property sector that enjoys stronger fundamentals. And that sector is manufactured housing communities and RV parks. These specialty residential properties enjoy many advantages relative to single-family rentals and apartment communities. Firstly, as the landlord, you typically only own the land and the associated infrastructure. Your tenants then lease the site and they bring their own home onto it, which means that they are responsible for the maintenance of their own home. Secondly, because it's impractical and expensive to then move a home from one community to another, your tenants are a lot more dependent on you, they are unlikely to move out, and you're in a stronger position to enforce rent hikes. Thirdly, affordable housing is always in high and growing demand, yet the new supply of such properties of manufactured housing communities and RV parks is strictly limited because of restrictive municipal approvals. No one seems to want a new manufactured housing community in their backyard, and as a result, there's a permanent supply and demand imbalance that favors landlords and has historically resulted in much stronger rent growth when compared to other residential properties. Just recently, Sun Communities sold its marina business to Blackstone, which allowed it to raise a lot of capital to deleverage its balance sheet and refocus on its best assets. I think that this makes the investment case even stronger, and yet Sun Communities is still today trading at a historically low valuation and therefore expected to keep outperforming the Vanguard real estate ETF going forward. Hey, before I go into the third REIT, can you please do me a huge favor and click the like button if you think that this type of content is useful? Thanks so much in advance. The third REIT on today's list is CubeSmart, ticker symbol QUBE. And once again, this is a REIT that focuses on a specialty property sector that has historically enjoyed stronger fundamentals, which have then resulted in strong outperformance relative to the broader REIT market. And that property sector is self-storage. CubeSmart is one of the leading self-storage investors, and this is a property sector in which the scale of REITs can be a major competitive advantage. The scale allows them to build national brands that are very valuable and easily recognizable. They can then also implement national TV and billboard ad campaigns, also on social media. They can also implement highly sophisticated revenue optimization models. And these are things that are out of reach for smaller, less sophisticated landlords, giving REITs a competitive advantage to earn above average returns. It provides an opportunity for REITs like CubeSmart to acquire properties from smaller, less sophisticated landlords, then change its brands, implement better revenue optimization models, better marketing strategies to immediately boost the cash flow quite significantly and create a lot of value. It's a simple strategy that has historically resulted in significant outperformance relative to more traditional property sectors like offices, where scale and brand value isn't that important, isn't such a big competitive advantage. And we think that this outperformance is set to continue going forward, especially since the valuation of CubeSmart is today historically low. And we think that the AI revolution is set to significantly accelerate the demand growth for self-storage properties. And the simple reason why is simply that I think that AI will result in significant labor market disruption, with a lot of people losing their jobs, having to move around to find new ones, perhaps downsize to a smaller home, and all of this has historically led to significant demand for self-storage space. But right now, this narrative that self-storage might be one of the biggest beneficiaries of the AI revolution has still been overlooked by the market, and therefore I think that now is still an interesting time to invest in self-storage REITs like CubeSmart. The point that I try to make in this video is that not all property sectors are created equal. Some are a lot more attractive than others, yet REIT ETFs like the Vanguard Real Estate ETF will invest in all property sectors across the board because they are not in the business of picking and choosing, they are simply in the business of giving you broad exposure to the entire market. This can be attractive for some sectors of the market, but I think in the case of REITs, you're leaving a lot of money on the table by being diluted by the poor returns of offices, hotels, malls, mortgage REITs, diversified REITs, externally managed REITs, and many other problematic REITs that you could easily screen out to focus on the best REITs like VICI Properties, Sun Communities, CubeSmart, and many others. If you want to gain full access to my personal REIT portfolio, you can join us for a 2-week free trial at High Yield Landlord. It will be the second link in the description of this video. Finally, as a reminder, you can now temporarily access for free our interview with the CEO of Whitestone REIT, which is one of our biggest retail REIT investment today. Click the first link in the description. Once more, thank you very much for your support. If you could please click the like button, that helps me a lot. Thank you. See you in the next one. Bye-bye.